So then we can just begin telling the story. So please interrupt me if there's anything that is I am unclear about, or you feel that you need clarifications of. But so just to tell you, as Thomas mentioned, I was engaged with the Parliamentary Special Investigation Commission. I was their first employee. This commission was set up by Parliament right at the height of the crisis, so in December 2008, right after the collapse of the three banks. And there was a lot of pressure on government to actually reveal what had happened, as this came as a big surprise to the public that these fine institutions that had been conquering the world, so to speak, simply as if they were swept off the face of the earth, or they came crumbling down in a matter of few days. So Parliament responded to this outcry by establishing what you can call a truth commission, looking into the causes of the collapse of the three banks. So, and I was with them from start to finish, and I'm going to tell you what we found. So, let me see. So just briefly, right after the banks failed, the currency, Icelandic krona, collapsed by 41% between January and October 2000. Sorry, right before the collapse. Already we had seen the currency give in by 41%. It gave in even further right after the collapse. So virtually 70% of the value of the currency was wiped off in 10 months or 11 months. Now, inflation shot up to 18.6%. Asset prices fell sharply. The stock market lost 98% of its value, simply because the three banks were the largest assets traded on the stock exchange, or almost two times Iceland's GDP. Was worth of the drop of the index, the stock market index, by this. Now, unemployment peaked at 9%, very unusual in Iceland. We are few and we have a lot to do running a modern society. So usually people have at least one jobs, if not two or three. Now, nominal wages were stagnant for a long period, and it was sort of a consensus that those at the very top saw their nominal wages even being cut significantly if people did not lose their job downright. Now, the central bank, and rather unusually, and the commercial banks had to be recapitalized by 65% of Iceland's GDP. And if we talk in terms of net injection, that is how much the government needed to inject the banks with capital, given how much assets they took on against that liquidity that was injected. We have the outright payment made by the government at the height of the crisis was around 17% of GDP in Iceland. Now, at the height of the crisis, so during these days when the banks were falling one after another, and after the third one had indeed failed, an emergency legislation was passed by Parliament, mainly to protect depositors in Iceland, so placing their claims ahead of all other creditors. And this indeed was coined as the savior of Iceland. Had we not done that, depositors in Iceland would not have been able to retrieve their money, which would probably have had much more civil unrest in this scenario, at this time. Now, all three banks went into receivership. The domestic side was bailed out, the domestic operation of the banks. The government simply bailed them out and set up a domestic bank and a foreign bank. And the foreign banks that held foreign assets of the failed banks were held in receivership, and but the domestic side of the banking system was held up and running. Later on in 2010, when the government realized basically that the risk of taking on the recovery risk of these assets that were held that were needed restructuring within the banking sector was simply too high. The government broke a deal with the rather abruptly and unexpectedly broke a deal with the creditors and pushed the equity risk of those banks over to the creditors themselves, who held these assets until, well, Arion Bank, for example, was simply sold off in an IPO'd 8 years later. But we are not going to go that far into the story. But this is the gist of what happened. Now, 97% of the banking sector collapsed, and the simple reason was it did occur as a result of the rapid credit growth that had happened during the 5 years and the run up to the collapse. The size of the banks' balance sheets, sheer size of the banks, compared to Iceland's GDP, was simply so big, and inadequate financial supervision to regulate these 3 banks. That was sort of the obvious explanation for people who have been studying banking and financial supervision regulation responsible for the financial sector. That was obvious to professionals, but the public needed a little bit more convincing and explanations as to why this had happened. So I have written a book on the conclusions of the Special Investigation Commission. So it issued a 9-volume magnum opus on the events, describing the whole truth, we would like to say, of why this happened and how. And that's exactly what we needed to express, or the commission was responsible to do, is to tell the public how this incredible events had taken place, why they had taken place, why nobody stopped this risky development. And then in this lecture, if we have the time, we are going to talk a little bit about how Iceland did recover. I did not cover that in my book, but Sigríður Benediktsdóttir, who is incidentally at Yale University, and Kaupthing Eggertsson and Eggert Þórarinsson published a very nice paper on the whole process, the rise, fall, and the resurrection of Iceland at the Brookings Institute. And I highly recommend both of these paper and book, because they, so my book is more about the background and more about the people involved taking the decisions, descriptions of what Tim Geithner, for example, did, and Gordon Brown and other people who became famous after as policymakers and the watchdogs over the financial sector, became famous after the financial crisis. Now, the Parliamentary Special Investigation Commission was set up in December 2008, and its mission was to seek the truth behind the events leading to and the causes of the downfall of the Icelandic banks in October 2008 and the related events. And furthermore, the committee, or the commission, I should say here, shall furthermore assess whether mistakes or negligence, this is quoting the law, occurred during the implementation of the laws and other rules regulating and providing for control of the Icelandic financial sector, and what persons may be responsible. That was quite difficult in such a small, interconnected society for anyone to point a finger at another without some sort of a blame game starting. That's one thing, but also to find people who are unbiased was also quite challenging. Now, the investigative resources were extensive, to say the least. In fact, according to the legal act regulating the legal act on the parliamentary commissions, all confidentiality was lifted towards the employees and the government officials or other individuals that were reporting to the SIC, so the Special Investigation Commission. So essentially, the SIC had these exceptional powers to collect data. It had powers to search all premises, seize evidence considered necessary for the purpose of the investigation. They could subpoena witnesses, and if there were any suspicion of criminal conduct, the commission needed to notify such conduct to the special prosecutor, who then took over after the Special Investigation Commission had finished their job. The special prosecutor took over and started prosecuting for the criminal conduct. And this was a successful sequence of tasks, let's say. It would have been unsuitable if the special prosecutor would have started prosecuting and the Truth Commission would come out later on with its judgment or with its conclusions. That indeed happened in Ireland, and or rather in Ireland, Greece never the similar truth commissions that were to be set up in those countries that also suffered gravely from the financial crisis, intended to do essentially the same thing as the Icelandic Commission. The Greece Commission was more geared towards foreigners, therefore under more like a political influence, and the Irish one was also took a long time to finish their job, and essentially people had moved on when they issued their report. Now we could have another talk on comparing these commissions in different countries. That is quite interesting, and we have scholars who have been doing that in political science, for one. Now, the scope of the research is such that if we combine the three Icelandic banks, it amounted to be the third largest bankruptcy in history. So right after Lehman Brothers and Washington Mutual, I'm not aware of anything that has happened since that is quite that large. So even though Iceland is a tiny country with only 360,000 inhabitants, it managed to grow a banking sector of the size of 10 times GDP almost, and be the third largest bankruptcy in history ever. Now for this, and because of this sheer size of this shock, I think people were able to convince the parliamentarians to allow for such vast data collection privileges for the commission. So since it was allowed by Parliament and there were no privacy issues any longer towards the work of the SIC simply collected all the data that was to be collected almost. So all funding of the banks, all bonds that had been issued, all securitized debt that had been issued in the country over this five-year period, all collateralized loans, the discount window between the central bank and the ECB, Also, to a degree, the SIC had access to all deposits, monthly stock, free weekly flow, because at the end of the day, the banking sector, even though in its entirety, the foreign assets included was large, it was manageable to look at the domestic side of things at least. Now, the bank lending portfolios, of course, were all collected to whom the money was lent to. The foreign exchange trade data down to seconds, and the registry of enterprises was also collected because the parliamentarians specifically asked for cross-ownership to be investigated. So shareholders of each enterprise over a 5-year period, including all changes of ownership of all companies in Iceland. And they were on average 23 to 30,000 corporations set up in Iceland each year. So, and on top of this, tax authorities handed in their data over the same period. So this was extensive tax data collection that gave the investigators an opportunity to fulfill their mandate. Also, incentive pay was scrutinized, how incentives were laid in front of the bankers, such that, or to encourage them to lend money at a fast rate. And we needed to look at that too. Now, let's turn to the question, how did this happen? It started out with liberalization of the financial sector in 2003 over here. And the banks were privatized. Then a year later, these 3 banks with their energetic bankers went into the international bond market, mainly the European medium-term note market, as there was plethora of liquidity as a result of what Bernanke has called this global saving glut. Plenty of liquidity was to go around. The Icelandic bankers, with their stellar credit rating that was inherited by the Icelandic state, could go into the markets and issue a lot of bonds and borrow money from the Europeans to the largest degree, because not least due to the fact that they were willing to pay interest rates at level of other emerging market institutions that had lower credit ratings. So there the financier saw this beautiful combination of low risk and high yield, and that was an easy sell. Now you can see here how the European market opened up to the Icelandic bankers initially, but then the market basically closed on them in 2006. And then the Americans come in, and the American subprime lenders came in. And in fact, the Icelandic banks were not a victim of subprime lending themselves, but indeed they were subprime borrowers instead of lenders. Now, more on that later. Here you can see how these banks had to have the repayment schedule of these banks. So they went forcefully into the market, they borrowed a lot of money, and as if they didn't really think about the payment structure, considering the size of the currency. The Icelandic krona was tiny and the small economy. And here you can see how the repayment schedule of Glitnir, Kaupthing and Landsbanki, and from the time they collapsed and until only 6 months later in April, 7 months later, April, May in 2009, these 3 banks had bonds that they had to repay of the amount of 20% of GDP. So if you only had Icelandic krona, had to exchange it for currency, the currency would surely collapse, and that is one of those indicators that the regulators missed, basically. Now here you can see, for example, how the outstanding debt duration, so how much did they manage to fund themselves in over longer term or shorter term. So basically here you can see that on average they owed money for 3 years period, and then that they managed to extend their borrowing horizon. But as markets started to become less open to them, they had to accept shorter term funding to a larger degree. So you can see how that dropped sort of towards the end here, and they had to start paying up or refinancing at a more rapid rate than before. Any questions so far? Am I clear? All right. So in the beginning,
that's
yeah?
okay. So I this is David Lighton here. I'm actually reading a book right now that gets kind of deep into this and the demise of David Oddsson. Can you add anything about central bank policies under Oddsson and how irregular they were versus just being sort of liberal in the sense of deregulating things? I understand he wasn't terribly experienced with economics, and it led to some controversy in the end.
Right, you're absolutely right. So I mean, he was basically would not have been hired to do this job in any other country, I think. But the thing is, to a large degree, it was incompetence that contributed to the story here. Oddsson, basically, his main failure on the job was accepting collateral for the liquidity support that the central bank provided to the three banks, to the degree that the banks were basically playing a merry-go-round that described itself in such a way that Glitnir would issue a bond, hand it over to Landsbanki, Landsbanki would go to the discount window to the central bank to get liquidity. So no initial investor had backed the investing in bond that Glitnir issued. So this basically was a money printing machine that the three banks had used for their advantage. But according to the bankers that the SIC interrogated, basically said that this had been the common practice among bankers in Europe too. So I guess David Oddsson wasn't the only one to be tricked in this way during this period. So that's a lot can be said about Oddsson, but maybe you can keep this story too for now. Does that answer any of your concerns?
No, thank you. That's terrific. I would just add that there's a professor at University of Pennsylvania named Adam Grant who's makes a caricature out of him as an example of a guy who was much more confident than he was competent, and why that is a bad thing for anyone.
I need to check that out. Thank you for alerting me to that. But here you can see that the terms were good in the beginning, and the bankers enjoyed the rates of 20 points above LIBOR, just like the big investment banks in America initially. But here you can also see this picture here is the 5-year bond issues that were made. So 1 billion euros, so 1,000 million euros were issued, for example, late 2005 at 20 basis points, but then soon enough, the money starts to become more expensive for them, and at the middle of 2007, they were paying close to 10 times the rate that they used to in the beginning. But if you just, this is the first lesson you learn in statistics, you should plot your data before you do anything else. And when you look at this graph, there's something that strikes you here. That's probably those little dots here that are below LIBOR. So this is market issues. and somebody in the market is willing to lend Kaupthing money that is below LIBOR, where other market participants are requesting 30 basis points up to 50 basis points and even close to 100 basis points. And when you see patterns like these, of course, if you are in law enforcement or anti-money laundering, you should be drawn to these types of dots. Any questions here? Now, in the beginning, as I say, they had a stellar credit rating, and even in February 2007, the Moody's, the credit rating agency, granted the banks generously the highest credit rating, AAA. That was a double-edged sword for the bankers. One, because people quickly understood that was clearly an erroneous credit assessment, because these banks were just so big compared to their lender of last resort. That was obviously no longer a lender of last resort, because the deposits in foreign currency was 7 times what the central bank had in foreign currency reserves. So they could never have bailed them out. Anyway, the Moody's guys quickly corrected their models and arrived at a lower rate 2 months later. Now that drew, of course, attention to the banks, but somehow they managed to stay afloat for quite some time still. But trouble started already, though, in 2006, when we had this so-called Geyser crisis. This Danske Bank pointed out that the banks had grown at such a rapid rate. It was overheating in the economy. Inflation was already closing above 6%, 7%. Unemployment was very low. The currency had appreciated extensively. So overheating was clearly in the charts, and the markets responded. So basically, credit default swaps, so insurance essentially against the default of the 3 banks, if one of them was not able to pay back their bonds, the investor would then receive a payout from this policy. So this policy was initially priced at 20 above LIBOR, and then it reached 5-fold that in only a year and a half. Now that did not compare to what happened later on, when the big Blue Mountain blew up on them, and the CDS spreads crossed the 1,000 mark. So when you see insurance that is so pricey, basically the house is on fire and nobody wants to enter it. And that was a good sign, in fact, a very accurate one. This market is not like the stock market. Of course, it's quoted maybe once or infrequently. And the contracts, the insurance contracts against the 3 banks amounted to $70 billion US dollars before, and that was revealed after the banks had collapsed. Those that were insured brought their defaulted bonds to the insurer, and those bonds were auctioned off, and 70 billion had been insured. And in comparison, Lehman Brothers CDS contracts outstanding at its default amounted to 72 billion. So this was not a thin market at all, and a very strong market signal. So due to this, the Icelandic banks could no longer afford to fund themselves in the bond market. So they had to turn elsewhere. And where did they go? They first went into the central banks, Central Bank of Iceland. And here you can see how much the yellow line shows you how much they are drawing on in terms of liquidity support from the Icelandic Central Bank. So essentially, the Icelandic central bank is basically keeping them afloat and funding 9 billion euros at this time. And the rescue package from the IMF and the Scandinavian countries amounted to be 3.5 billion euros to get us through the crisis. So you can just see the comparison here. It was huge. They were basically completely dependent on the central bank there already early on. Another signal that the chiefs of the central bank should have been quite alarmed by. Now, let's get back to the growing banks and how much they grew and at what rate. There was phenomenal growth, 20-fold nominal growth in size of the balance sheets. Combine them in 7 years. Now, the explanation that the Icelandic bankers usually gave when they were criticized by this, criticized by other financiers pointing out that they were growing too fast, they basically claimed that it was all acquisitions, and they were buying up ready-made portfolios through acquiring financial institutions abroad. But indeed, that was not the case, because their organic growth was also phenomenal. You can see here year-on-year annual organic growth amounted to 60%, so 50%, 60%. Now, FDIC has a rule of thumb: if a bank grows more than 5% a year-on-year, that is considered rapid growth. And they are aware and have a heightened scrutiny towards that type of institution. But here you can see 10 times that. And yet the central bank and the supervisory authorities in Iceland did really nothing. Now, what did they do with the money? Who are they? They are the banks, the bankers. What did they do with the money? So there was a lot of money coming into the Icelandic economy, funded through foreign markets. So the investigators had to look into the portfolios and see whether indeed the story that was put forward, this acquiring mode, or the story that the Icelandic banks were conquering other markets, whether that indeed held towards further scrutiny. When looking through, although I should tell you that the Special Investigation Commission only had data allowances towards the Icelandic operations. The Commission did not have access to the foreign operations in the same way. However, there was a cooperation between the Luxembourgian authorities and the Icelandic Commission that allowed the Commission to look into get snapshots of the portfolios there. And there's bank secrecy on deposits in Luxembourg, but apparently not on debt. Now, looking at that, 60% of the loan portfolio of these three banks were extended to foreign entities and holding companies in 2007. But if you look further, indeed, these foreign entities were either owned by Icelandic tycoons, the collateral that was pledged was Icelandic, or had some sort of Icelandic connection. So the SIC concluded that indeed the majority of the loan book was indeed Icelandic risk dispute, or so therefore casting doubt on the story, or I mean, it wasn't as if half of the loan book was indeed foreign, but or almost half, but still a lot of money was tied to Icelandic risk. Now, then we have to ask ourselves, given the amount of money coming in, so bank credit to GDP went from 100% or 1 times GDP to almost 10 times GDP. So how is it possible, even though only half of it is coming into Iceland, how is it possible to extend such an amount of credit in such a tiny economy, given the legal constraint that allows only for 25% of the equity base of that bank to be exposed to a group of related parties. And this needed to be checked by the investigators of the commission. And here you can see how they did it, how they allocated the credit. Basically, as they were lending the money, they invented a new special purpose vehicle, or they accepted equity as collateral. SPVs with a slither of equity were formed and then piled with debt from the banks in order to either buy shares in the banks themselves or go out to the high street of London or Copenhagen to buy operational firms. So this picture here shows you the interconnectedness of the concentration that risk that was building. And you see the big nodes here are the banks themselves. So Glitnir Bank here is the blue one. And this is their ownership connection to a company. Either they are owned by Glitnir or the entity owns Glitnir. That's the links here. Between the bank and entities that are larger than $500 million $5 million balance sheet. So these are large companies in Icelandic reality. And here, for example, you can see this is Draumur Burðarás here. This is Deutsche Bank lending lending money to a string of companies. This is a structure that Deutsche Bank designed in order to secure collateral here. And this is in relation to activists, funding the shareholdings of activists. Lending to the shareholders of activists due to the purchase of activist shares. Any questions here? Now,
Gudrun, let me just ask a question. I'm quite interested in this offshore stuff that really never got completely analyzed. So one of the things you could ask about this was the role of kind of Russian and Middle East finance in this situation. Did you get into that? Some of the relationships that showed up there with Usmanov and the UAE.
Namely, because of the mandate of the commission was simply to seek the truth behind the failure of the banks. That means the commission had to limit its scope to that narrative, basically. But there were hints as to what was going on, anti-money laundering, if you will. But the commission itself did not have the mandate to follow the money in that sense. But it had the responsibility to flag such suspicion of criminal conduct to the special prosecutor that should have taken over these cases. And in some cases, in fact, the special prosecutor did so. But mainly they mainly held up cases against the bankers in relation to their market manipulation or credit leak note when they were trying to manipulate the CDS market. But that's also an interesting story that I'm not covering in this lecture, because it was more like a side story. It didn't explain the failure as such. Does that answer the question?
Yeah, I mean, there's also this peculiar situation where Putin showed up in October of...
and another one, yes, exactly. In October, after October 6th, the Russian ambassador approached David Oddsson at the central bank and offered a helping hand. But indeed, that was after the failure of the bank. So the commission ended its investigation and limited it to the events leading up to the collapse and that date, October 6th, basically. Everything after was to be handled by police or the prosecutors or somebody else.
And it hasn't been. Is that fair to
No,
say?
no, I couldn't say, no.
Yeah. Okay.
Now, since the commission had the entire bank portfolios in their database, it could test whether this legal threshold, remember the 25% of equity base that could be exposed to the same related party. So the investigators assigned or through network analysis, and this was one of the earliest ones you can find in the economic literature at least. Matthew Jackson, for example, his famous book on social networks in relation to economics was published the year the SIC report came out in 2010. So it was not a commonplace for economists to make use of these tools, but the investigators in Iceland actually managed to jot out who were related to whom and could therefore assess when that legal threshold had been broken. And here you can see the legal threshold to 25%. And here is Baugur Group, that's one of the main shareholders in Glitnir. And here you can see the red line shows the combined credit that Glitnir got out of, that Baugur got out of Glitnir was above the 25% threshold almost the entire time. And then Baugur became the controlling shareholder as Glitnir started to be less accommodative towards Baugur's lending requests. Baugur simply became one of their controlling shareholders and received even more lending or borrowed even more from Glitnir to the degree that almost the entire equity base was exposed to Baugur and its related parties. Now, here is another buddy of theirs who became the controlling shareholder or was in for the right to become a controlling shareholder in Glitnir. And that exactly happened here in June 2007. And here you can see the access that funds this investment boutique access that funds had to Glitnir's funding. Now, virtually the same story could be told in all of the three banks, just to a varying degree. So the largest exposure Landsbanki had was indeed to their controlling shareholders. But it really only touched upon the legal threshold here in case of Björgólfur Thor Björgólfsson, who incidentally also became rich by selling Heineken, a beer factory in Russia in the 90s. He was a big borrower from Landsbanki, and so was his father, but incidentally they were, and that Oddsson is a poet, and he mentioned the fact that the mother of Björgólfur must have been upset by the assessment of the bank, considering Björgólfur and Björgólfur Guðmundsson not being related as they were a son and a father. But in the jargon of the financial industry, related parties need to be dependent on one another in one way or the other, both from a managerial control perspective as well as risk perspective. Now, Kaupthing's exposure was similar. The controlling shareholders there also were big borrowers, and in the case of Exista, an investment boutique in Iceland, a big shareholder in Kaupthing, indeed was granted credit beyond the legal threshold. Now, seeing all this, the SIC concluded that the loan book quality was eroded and was marked by excessive risk-taking as the time passed. Now, this excessive lending to entities, well, the loan book amount in large degree, the loan book was comprised of entities that essentially did not have a regular installments on of their loans. Namely, zero coupons were the largest form of debt issued, meaning that there was no cash flow. So how could the bank have ever been able to run in a smooth way if the bank was obliged to pay interest or even installments or payments of the loans, but their customers didn't have to pay anything at all until at the very end of the maturity of the loan. So this is a huge gap, and people at the New York Fed had there was a remark when I gave a talk there. Well, this is just a Ponzi scheme then, and so the bullet loans became the largest share of the portfolio, or zero coupons. So that drew the attention of the investigators over to what type of collateral was pledged against these loans, and their data quality was quite poor, but the type of data or type of collateral that were very well recorded was collateral that was taken in the form of stocks. So stocks that had been pledged to as collateral into the banking sector was very well recorded, and that we could also, the investigators could easily see the value of the collateral from one day to the other, and that was very interesting study to do. And here you can see that in the case of FL Group, not yet another investment boutique that used to be an airline, Icelandic, turning into a closed-end fund. About 75% of all outstanding shares in FL Group had been pledged into the banks as a collateral. Now, what came as a big surprise to the investigators, and to their horror, I should say, is that here you can see listed share pledged as collateral in Kaupthing. So what type of collateral had Kaupthing accepted? Well, 40% of all outstanding shares in Kaupthing were pledged into Kaupthing. And that's another journalist here in Iceland, Þórður Snær, issued a book that just recently in Icelandic that had the title "The Bank That Owned Itself," and that's exactly what it is. Now, by the IFRS accounting standards, you should deduct this type of shares. If you lend money towards your own shares, you should deduct those shares from your equity base, and that is kind of something that they forgot about, and we'll go into that a little later. But of course, that meant that the bankers were extremely sensitive and sensitive to the price of the stocks in the market. That led the investigators to looking into how they then behaved in the market. So how were they buying and selling, for example, their own shares in Kaupthing, in the case of Kaupthing. And here you can see above the line, Kaupthing is buying on the stock exchange, either initiating themselves or not. And here you can see below the zero, Kaupthing is selling on the stock exchange. And if everything was normal, this should be mirror images, right? But here you can see that they are buying and buying and buying on the stock exchange, but they are just not selling anything at the very end. So how do they do it? Then we look at the figure here. Here is the buying and selling of own shares in Kaupthing on the stock exchange versus over the counter. So here you can see the blue columns is on the exchange, and they are buying and buying on the exchange. And what are they doing? Are there any blue columns here down below? No, they're only over the counter. So there's buying on the stock exchange to prop up the price, and then they're selling over the counter. And how are they doing that? They did that by selecting, for example, their own or giving their own staff members chances to buy or have leveraged buys in the stock or the shares of Kaupthing, or funding a special purpose vehicle, again with this tiny share of equity, and then piling debt on it, and that SPV would then go into the market and take over these shares that Kaupthing had bought in the market. Here's also one of my favorite graphs in the entire 2,400 pages, and this is something that might have relevance today. Here you can see how the banks are increasing their will to lend for stocks, so lend money to margin trades. Basically, customers are borrowing money to buy shares on the market, and here, as long as there's an increase in capital flowing in the form of debt into the stock exchange, the price on the stock exchange is rising. But as soon as the banks are no longer willing to accept stocks as collateral, the price drops like a rock. Okay, now how are we with time? We have 10 minutes. So are there any questions here? So I will leave you with those slides. So I'm going to tell you very quickly the downfall. Basically, the largest Icelandic investment companies were funded through the big investment houses in the US. And several of these loans, as the price was dropping, the US banks basically called on the margin. And because the Icelandic banks were so dependent on the stock price, they felt that they needed to bet for life by taking over the funding in themselves. And instead of having the controlling share to go into the market, sell the shares, pay off the US banks, and be therefore at the mercy of the stock exchange and seeing their prices dropping, and therefore the collateral that had been taken over go down, and then you would have a spiral going down, and they would be, game over very soon. So the bankers basically felt that they needed, for the sake of saving larger interests, to take over the funding themselves. But they failed to deduct these own shares from their equity base, which led to the falsification of equity and false market signals, derailing the regulators who thought that they indeed had much more capital than they in fact had. So here you can see the CAD ratio, the capital adequacy ratio, was recorded or reported by the financial statements to be a healthy 11% here. Kaupthing close to 12% until the very end. But indeed, had you deducted these shares that had been pledged, the CAD ratio would have fallen very close to the legal limit of 8%. And in case of the Landsbanki, a year before the bank collapsed, it probably didn't have enough capital to meet the legal limit. So the regulator should have intervened at least a year before the bank collapsed. So what type of incentives does that give to a banker, knowing that their bank is going down? That is, of course, going to have an effect on the quality of the lending that the bank engages in. So the ISEF story is one interesting story. Remember that the Icelandic banks couldn't fund themselves in the marketplace. They went to the central banks, and then they went to the streets of London and Amsterdam and collected deposits from people that were lured by their favorable rates that they were offering. But Landsbanki, but soon enough, to make a long story short, after the collapse of Lehman and Glitnir and Landsbanki's collateral, that they had pledged their own bank bonds into ECB, for example, and as Lehman Brothers collapsed, well, their collateral in ECB fell sharply, and then ECB, European Central Bank, had also lent them a lot of foreign currency, basically called on the margin, and they couldn't deliver. So Landsbanki requested a loan of last resort from the Icelandic Central Bank. The iSafe accounts were run upon because people in Britain and the Netherlands were aware that these banks were going down. Therefore, the Landsbanki had nowhere else to go but to the lender of last resort, the Icelandic Central Bank. That couldn't deliver because the stock of deposits in foreign currency was just far beyond what the Icelandic Central Bank had on their reserves. So having little liquidity to meet these bleeding online accounts, Landsbanki did not meet the requirements of the British financial supervisory authorities. And therefore, the British FSA felt compelled or felt the duty to act and protect their own constituents by moving the accounts from Landsbanki over to ING. And by doing that, also all assets of Landsbanki were frozen to meet these all assets to meet these obligations that the debtors had towards the bank. That is vis-a-vis or through the one toolbox that they had, the Anti-Terrorism Crime and Security Act that had been installed in 2001. And so the so-called Terrorist Act was made use of to freeze those assets, and Landsbanki, therefore, its fate was decided. Anyone here?
Yeah.
Similar story to in the case of Kaupthing, except for the subtle difference that Kaupthing did not set up a branch in the UK like Landsbanki had done, but it had set up a subsidiary. So that subsidiary was under the supervision of British authorities. And so it was not the Icelandic FSA that was responsible for the financial oversight of those entities. And there was a difference. Basically, Kaupthing and Singer & Friedland, the subsidiary in the UK, had been supplying the mother company in Iceland a foreign currency because they were also offering deposits at a favorable rate. But the bankers kind of tricked, they engaged in liquidity swaps and counted the money twice or three times, such that to derail the supervisors and the British supervisors in believing that there was enough liquidity to be had. Sorry, I failed to mention that the British authority therefore was much more stringent towards liquidity requirements of the subsidiary of Kaupthing in Britain, requiring Kaupthing to keep 95% of all of these deposits liquid, in liquid assets, on the contrary to the Landsbanki. Landsbanki was free to do whatever with those foreign deposits that they had collected. So when the British authorities discover that, and here you can see that on this graph, is that the collateral that the Icelandic parent company was providing its subsidiary, as the mother company is drawing a credit line, the yellow line here, getting more and more out of the subsidiary, the value of the collateral that they are supplying collapsed, and there was a big gap here. And this is what the British authorities saw, that there was missing 1.6 billion pounds. And that's when Gordon Brown got involved, called the Prime Minister in Iceland and said, these bankers are tunneling money from Britain, from the British depositors up to Iceland to fund their refinancing of bonds that Kaupthing Iceland needed to pay elsewhere. And this needs to stop. And nothing happened, so the British authorities responded by moving the 500 million pounds to, by moving, taking over simply the KSE operations. And that was the fate of Kaupthing, and therefore all other loans, obligations that Kaupthing Iceland had towards foreign creditors was due immediately because there was a subsidiary missing. Am I clear?
Yes, Gudrun. Let me just ask you to step back from this and talk a minute about what we've learned from the Iceland story. Have they really made concrete changes? And how many people went to jail as a result of this? You have stories about Iceland punishing its bankers when Americans didn't. So
yes. Let's go through that. Sorry, I get kind of engaged with the story. There are so many avenues to take. The Special Investigation Commission ruled or found that, as they were supposed to, attribute failings to persons responsible for regulating the bankers, that the Prime Minister, the Minister of Finance, the Minister of Business Affairs, the Director General of the Financial Supervisory Authorities, the 3 governors of the Central Bank of Iceland, all showed negligence in the meaning of the law meaning of the law on the Special Investigation Commission. So they basically failed in their duties. And the Prime Minister was the only one policymaker to stand trial for this neglected management and handling of the crisis. And he was found guilty on 1 account of 4 for not holding dedicated and keeping his cabinet informed about the crisis. So the fraud and the failure, or fraud or failure on part of the bankers, over 200 cases in total were investigated by the special prosecutor. That 71 cases were brought to court against 77 individuals, and 114 verdicts were passed upon at the district level, and the Supreme Court ruled out 52 judgments. So 80% of cases led to guilty verdict in the Supreme Court, and 90 years of cumulative prison time was passed. So the Kaupthing CEO, chairman, the controlling shareholder, Ólafur Ólafsson, and CEO of Kaupthing Luxembourg were sentenced to 3 to 5 years in prison for fraudulent lending practices and market manipulation, and other judgments were ruled in other cases, bringing the CEO of Kaupthing to the maximum penalty of, I believe, 5 years. So all additional verdicts didn't really lengthen his prison time. But CEO of Landsbanki was found guilty of fraud and market manipulation. He's still fighting in the courts because one of the judges had been a shareholder, big shareholder in Landsbanki, very unfortunate. And he has brought his case up to the court in the Human Rights Court in Luxembourg. And the CEO of Glitnir was also found guilty of market manipulation. So a lot of people went into jail. The big fishes certainly were sentenced, but a lot of people got away scot-free. So
what about, could this crisis happen again? Have you undertaken reforms that would prevent it?
So, I mean, the legislative framework or the legal framework has been tightened for sure. And the financial supervisory authorities, of course, is better equipped to take on their mission. I want to believe that this could not happen again, also because we have this extensive insights into what happened earlier, and therefore there's the warning of history that and the countervailing forces have been strengthened with free media one, although it's not big, but it is effective.
I have a question. I don't know if you can hear me. Thank you for the talk. It's incredibly interesting. Can you speak a little bit more to the exact market manipulation they were guilty of? Is this the point you made, that the shareholders in the company who are also borrowers of or in the banks who are also borrowers from the banks?
Yes. So
how
how
it
it works? Yeah.
Like, how is that not a Ponzi scheme? I don't know.
It is a Ponzi. I mean, it's not a pure Ponzi like the one that was, that we have the name from, but it is a Ponzi scheme. Of course it is. It is like a knitted sweater. Once the thread is out, it just starts to unwind, or wind up. So what they did was, as they saw, it was many avenues actually, but the main thread is that as the stock price starts to lower, they know that they have taken over funding from the controlling shareholders, or funding of the special purpose vehicles that were the main shareholders of the companies. They then start to, Landsbanki for one issued more shares and had the company in Guernsey be the buyer of those shares, and then there was a forward contract towards that company. So the risk of the shares of Landsbanki never left Landsbanki, therefore. And so then they start to trade themselves. So they in the market, they basically buy up own shares in the market. They then issue a loan into a special purpose vehicle that then buys those shares off the books, from the traders, and that's essentially what they did. So does that?
Yeah, that's very interesting. Thank you.
Yeah, I mean, it really tells you here how it is played out. So here you see that they are, so 60% of the volume in the stock exchange, so Kaupthing is engaged with 60% of all of the buying in their own shares on the stock exchange here at the very end. So they are the buyers themselves. And then they sell it into SPVs with borrowed funds from the bank. And this is completely illegal. I mean, this is why they went to jail. And this is how you can see also, I mean, economic evidence only goes so far. And luckily, the bankers also left a lot of legal evidence, like, emails. And I can tell you also that right before the Special Investigation Commission issued its report, the investigative resources of the police were enhanced such that they could tap into telephones of these bankers. So when the report was issued, SIC report was issued, they were listening in on the conversations between the bankers. And then that's where they discriminate themselves. Incriminate themselves, I say, sorry.
I have a follow-on question to this. You spoke, obviously these special purpose vehicles were based not only in Iceland, but in Guernsey, as well as in the UK more broadly. Was there any indictment to people in, or to regulators in the UK or in Guernsey or anything like that?
No, not that I'm aware of. No.
Great.
Well, that's a good follow-up. We're having Gordon Brown come next week, right, Thomas? He will be there with us.
Not so clear whether we can get him.
Oh,
He is erratic in his responses to my email.
okay. Well, pending that.
So I'm still working on it. But we should make the transition now to Jim, to your PowerPoint.
Yeah,
if
well,
you're
I was
ready.
just going to follow up with Gudrun because I think the general
Yeah.
case here, sort of the real world is a special case. Iceland is a special case. But I think it's important, Iceland itself is fascinating, but there's all kinds of stuff to be learned from this. One is simply the pattern of state capture,
Yes.
which we see where you have essentially a whole lot of very hungry bankers persuade people to go forward with a privatization that's ill-conceived, with a kind of optimism about markets that turns out in retrospect to have been loony. I just wanted to get Gudrun to comment on the role of the foreign financial community and places like Luxembourg and some of their offshore havens not asking enough questions about what was going on, basically turning a blind eye to a lot of the sketchy lending that was going on and the round tripping of loans. But at some point, US banks also got involved in this to a great extent. So can you just talk about that?
So we are seeing heightened awareness and heightened follow-up on money laundering and such today. I mean, that's the scandal of the Scandinavian banks, for example,
Yeah.
Danske Bank. Indeed, it was an American bank that got the police on the tail of Danske Bank. JP Morgan alerted, and so there. I do have this maybe childish hope that people have learned from this and to some degree. But money talks, right? And as long as we do not rein in the incentives of the bankers to behave and extend loans that have this effect, like we saw in the Icelandic case, people just are going to respond to their incentives. And so why were we able to do this in Iceland? Well, it was the general public that demanded it, and there was a political capital that was built up after the crisis that made it so that politicians were elected that had the courage to stand up to these powers. I mean, I haven't been looking specifically into offshore activities myself that much, but we know from my studies and from my research on financial networks, we do not even have the statistical tools out there readily available for the financial supervisory authorities to track funds properly. And ownership of companies needs to be transparent, and we need to have a big global cooperation to reach that point. And we can't really tell much about global financial transfers since we do not have the access to the data.
Yep. Excellent.
We still have a question from Enzo.
All right, thank you so much for speaking with us today. My first question is whether the investigation by the SIC involved going back in time to try to understand how the privatization of these three banks worked. And then, going forward is whether there were other banks involved, because we've only talked about the three major banks, but I'm sure there are other banks involved in all of this. were these other banks investigated as well?
Excellent question. And yes. We did, or the SIC looked into both ethical aspects, historic aspects, psychological aspects. It was a big interdisciplinary group of people who studied the different aspects to try to figure out why, how, what had happened. And in fact, the report that the ethics group, 3 people, philosophers, two of them philosophers and one gender expert, sort of gave their verdict, and that report actually resonated the most with the public, not the technical CDSs and all of that, with the public. So the way it was comprised between, there was an economic historian that issued a big report, a social psychologist issued a big report. There was a special report on the cross ownership, and there was and yet another contribution. So I mean, it is an effort to learn from. Not that it can be replicated because of the size of the shock. And you mentioned that there were 3 banks that amounted to 92% of the stock exchange. But yes, you're right. There were other banks, there were cooperative banks that were supporting. They were also captured, and they were captured not by their controlling shareholders, but by those big banks. They felt that they had to play the same game. And in fact, one of them was an intermediary in this merry-go-round of taking over bonds that were issued by one of the 3 banks, all of the 3 banks. They took all of them over and handed the bonds into the central bank. They took their cut. So they returned with a haircut liquidity to the three banks, to the degree that this credit risk that this tiny bank had towards the 3 huge ones was 11 times their equity base. It was like mind-blowing. And this is exactly the reason this part that this small cooperative bank played in this merry-go-round resulted in the central bank being bankrupt. Okay, bankrupt. There was no asset to back up the money that had been issued by the central bank. So at the end of the day, this all needs to balance out, right?
Yep.
Yeah. So very good questions.
One more question for you, Gudrun. I can't resist. I was on this group that went to Iceland in the summer of, I think, after the crisis, to investigate the offshore aspect of this. And the fellow who was chairing that was Sigurður Ingolfsson. You may know him, but he never told me what the final estimate was of the volume of offshore private assets. I think it was a state secret. Has it been released, or is it? Do we know?
I don't know. I'm
Yeah.
sorry, Jim.
It was obviously not a small number.
No, I mean, the biggest foreign investor in Iceland was on the Tortola in the Cayman Islands.
Yeah.
That was the biggest foreign investor in Iceland.
Yeah.
The second biggest was Luxembourg.
Right, exactly.
And those, therefore, were not foreign investors.
Right.
Yeah.
Good. Well, thank you very much for an outstanding presentation. The finance curse is with us here in many ways, and we're trying hard to learn about these global financial risks.